Let's say that a public company has fixed rate high yield bonds. How would you compare the returns profile of investing in the bonds versus investing in the company's stock? So this is a common question asked in any sort of debt capital markets or equity capital markets investment banking interview. But there are several steps. The first is figuring out the yield of the bonds. And so here you're going to figure out what is the coupon payment and what is the ultimate difference between the par and the purchase price that you're going to get that sort of appreciation. And then you compare that against the equity yields. And so the yield here is going to be the free cash flow yield of the stock or the IRR of the private stock investments. You're going to look at the dividends, you're going to look at how much it appreciates in value, and then there's a qualitative element. You've got to assess the risk. Like, what's the risk of the stock relative to the bond? Because the bond is going to be more senior in a liquidation scenario than the equity is. And so if something goes south, then there's going to be more value going to the bond holders than to the equity holders. And so you've got to consider that risk, you've got to consider the asset coverage, interest rate risk, all of that when assessing the worth of a yield of a bond versus the yield of a stock.